Hi guys, welcome back to my channel, Kelvin here. In this video, I would like to talk about bonds, and whenever a YouTuber talk about bonds, they like to joke what is a bond. They be like, Bond is James Bond, hew. Of course I won't be so lame. You want to hear a better bond joke? The interest rate on Singapore savings bond this past few months. If you don't get the joke, just ignore it. It was a very bad joke. But personally, I've always wanted to know which is better, stocks or bonds. Maybe you wanted to find out the same, but nobody ain't got time for that. That's why I've made this video to share what I have learned. What are the benefits of investing in a bond, and whether should I be investing in a bond or not? So let's first start by understanding what is a bond. Whenever you borrow money from a bank, you are the borrower and the bank is the lender, also known as legal along. And the money which you borrowed from the bank is known as bank loan. But let's reverse the situation. Now the bank is the borrower and you are the lender. That money which you lend to the bank is now called a bond. Now the borrower doesn't have to be a bank. It could be any company or even the government. In return for lending them money, the borrower will give the lender a fixed amount of interest every year. So let's look at some real-world examples. This is the Singapore Savings Bond, offered by the Singapore government. This bond matures in 10 years time and its interest rate starts from 0.23%, then slowly goes up to 1.79% at the 10 year. After that 10 years, your capital will be returned back to you in full. Let's look at another example, a bond by DBS. And yes, banks do issue bonds to borrow money from us, which will then lend the money back to us. Bondception. This bond has a 4.7% interest rate, also known as coupon rate. But this bond doesn't have a maturity date. Instead, it is a perpetual bond, which also means forever, like Wang Hong's Forever Love kind of forever. As it doesn't have a maturity date, you will need to sell your bonds to another person to get back your money. So let's summarize this. Bonds are issued by governments or companies to borrow money from the investors, and in return, they'll give a fixed interest to these investors. If and when the bond matures, they'll give back 100% of the money back to the lender. Now that we know what is a bond, let's look at what are the benefits of investing in a bond. Number 1. Fixed income. By investing in bonds, you will know exactly how much you'll be getting and when you'll be paid. For example, this is the November 2020 Singapore Savings Bonds. The interests are paid on 1st November and 1st May every year. If you invest in this and hold till maturity, your average return is 0.91% per year. Or this is Singapore Airlines Bond, also known as SQ, where the air stewardess say, excuse me. You will get 3.03% interest from this bond, paid 2 times every year. Companies' dividends can go up and down, like Ascenda's dividends which dropped recently, but bond interests do not fluctuate, so investors will know how much they'll be getting, making it a very stable income source. Second, lower risk. Whatever money you have invested in bonds, you will get back the money in full when the bond matures. Like if you have invested 10k in Singapore saving bonds, after 10 years, you will be getting back that 10k. Compare that to stocks, you won't even know how much that 10k is worth tomorrow. If the company is caught cheating investors by rolling a prototype down the hill, your money in their stock could be rolling down the hill too. However, even though bonds guarantee that you will get back your money in full when it matures, here's a very small footnote. You will only get back your money if the company hasn't gone bankrupt. In the event the company goes bust, your money will be gone. For example, many AMA and APEC invested in HyFlux just because the government is also investing in it. They thought that it is a very safe investment. However, in 2019, HyFlux filed for bankruptcy protection. All the AMA and APECs were unable to get back the capital. They were so angry that they went to Hong Lim Park to protest. So in short, a bond has lower risk because the company guarantees to pay back the money to you in full when it matures. But if the company goes bankrupt, you cry until no tears, also no use. However, there's a super easy way to avoid all of this, which brings us to the third benefit, clear ratings. Bonds are rated by international credit rating agencies, which will say it is a good bond or a bad bond. Which is like when you are young, your mom will always give the neighbor's kid a very good rating, but give you a very bad rating. Like, why can't you be like our neighbor Xiao Ming? He always get full marks in exams. This is the chart of bond ratings. If the bond has AAA, it is the best quality. But if it has BB or CCC, you know that it is a bad bond because in the Asian rating scale, B means bad and C means can't eat dinner. So for example, the Singapore Savings Bond has the best rating, AAA. Meanwhile, the HyFlux bond doesn't have a rating, but had an unofficial rating of B, which meant that the risk of default was very high. And the CEO will be deeply saddened if you lose money investing in them. Even though some bonds doesn't have a rating, there's still an easy way to check whether it is a good bond or not. and that's by looking at their interest rates. Remember this, when investing, the lower the returns, the lower the risk, Conversely, the higher the returns, the higher the risk. This goes the same for bonds. Good bonds have low interest rates, which is around 3% to 5%, while bad bonds typically have higher interest rates, like 5% to even 12%. So don't be tempted by high interest rate bonds because your money could be eaten up by them if you are not careful. Those were the benefits of investing in bonds. Now let's go deeper. Let's discuss whether you should be investing in bonds or not, right after you tap the like button to help support the channel. Thank you. In any investments, you have to choose between two things. Do you want stability or do you want growth? A stable investment could be your high-yield savings account, bonds, or even dividend stocks. They have lower risk and will give you anywhere between 1% to 7% a year. On the other hand, growth investments are like Tesla, Bitcoins, Amazon. You will have a much higher chance of losing your money, but you will get a much higher return, like 10% to even a few 100% a year. So if you are the kind that prefers stability and do not want the risk of losing your money, you can go for bonds. A general guideline is that the older you are, the more bonds you should have in your portfolio. Like if you are 30 years old, you should have 30% bonds. And if you are 75 years old, you should have 75% bonds. The idea is that the older you are, the lesser risk that you should take. Like imagine if you lose your retirement savings just because the company goes bankrupt, you might be forced to go to some park to protest. I agree with this guideline, but only to a certain degree. As of right now, I would not invest in bonds. Here is my argument, which is not financial advice, so take it with a pinch of salt. A huge reason why I'm not investing in bonds is because I'm living in Singapore. And in Singapore, we have the CPF, also known as the money that we can see but cannot touch. Every month, we will happily contribute 20% of our salary in CPF when it sits till 65 years old, collecting interest and dust. Then at 65 years old, you'll finally be able to touch a bit of your CPF money every month. My precious. For most people, the amount will be the full retirement sum at $1,350 to $1,450 every month, which should be more than enough for you to live on based on a study by Singapore researchers. It includes all the basic stuff like food, clothing, footwear, transport, newspapers, and even holiday expenses. So you are living like a normal person and not like some poor college kid eating Maggi mee every day. With the CPF acting as a bond giving me a stable income, which is enough for me to live on already, and with my investments giving me additional income, I don't see any point to invest in bonds during my retirement. However, not everyone can handle the stock market, and certainly not everyone can handle volatility, especially during their retirement. For example, during the 2009 financial crisis, dividends during that period dropped as much as 20%. If you were living on your dividend income during retirement and you have to suddenly cut your living costs by over 20%, that would be bad for your health. Meanwhile, the bond interest rates remain the same throughout it all. They'd be like, what market crash can it win? So if you do not want volatility and want an extra stable income during retirement, go for bonds. But you may ask, that's for retirement ma, what about before retirement? The market is so volatile, investing in bonds not more stable meh? As mentioned earlier, when investing, you have to choose between stability or growth. Both of them have very different purposes. Stability is to preserve your wealth, while growth is to grow your wealth. Let's use an extreme example. You put your money in the bank, like $500. You expect that $500 to be still in the bank tomorrow. You don't want to go to the ATM next week and see it become $400, right? You'll be deeply saddened if that's the case. On the other hand, you invest your money because you want to grow your wealth, not preserve it. Let's say you invest in the S&P 500. Your money will be growing 9.8% every year over the long term. Or if you have invested in Amazon 20 years ago, your money will grow much faster than your pay raise. But you may ask, what about stability? Don't you need stability in investing? You are right there. If you look at any stock chart, the stock price will go up and down. If you take the Bambi stock chart and zoom it all the way out, you will see a very clear trend. Good stocks will only go up, bad stocks will go down. And bad stocks that look like good stocks will first go up, then go down, not forgetting to show you a middle finger. What I want to say is, any volatility in stocks can be overcome if you hold it just long enough. There's a study by Vanguard that looks at the effect of having different percentage of bonds versus stocks in the portfolio. For example, if you hold 100% bonds in your portfolio, you will get a 5.3% annualized return from 1926 to 2018. In your worst year, you will have negative 8.1%. But if you hold 100% stocks in your portfolio, your annualized return will be doubled to 10.1%, even though the worst year is negative 43.1%. The moral of the story is, you do not need to invest in bonds just for the sake of stability. Because if you do so, you might be sacrificing a lot of returns just for stability, which you might not even need in the first place. So before you invest in bonds, ask yourself this: do you want stability or do you want growth? And that's all for today. Comment down below and let me know, do you invest in bonds? Like, share and subscribe, as I'll be posting new videos every Monday. See ya!